Welcome to this three-part series on how to take control of your financial future. My name is Liz Lucht, founder of YourMoneyRoadmap.com and author of Roadmap to Financial Freedom. Now, the subject of personal finance can be dull. It can also be pretty overwhelming. And especially in the times we find ourselves in, it can be particularly worrying too. In this three-part series, I hope to show you that this need not be the case. I hope to inspire you, no matter where you are in your personal financial management, to go to the next level, to take control of your financial future. Each and every one of us have in some way been affected either directly or indirectly by the recent economic climate. But I have good news for you. No matter what economic times you find yourself in, whether upturn or downturn, boom or bust, sound money management principles remain the same. And if you are disciplined enough to make these principles a part of your daily life, you can not only survive any economic storm, but thrive. You can own your financial future. Now, many people think that a pay increase or winning the lottery is the answer. But without applying sound money management principles, any pay increase and any winnings from the lottery will very soon be forgotten and replaced with a quest for another one. In this three-part series, I am going to give you the 4 keys to taking control of your financial future. So let's get started. The first principle is take control of your finances. A lot of people get scared at the thought of personal finances. I feel that way about IT. People think that it's so much easier to just bury their heads in the sand and have a que sera approach to their finances. Whatever will be, will be. And a lot of people are thinking that, if the experts can't get it right, what chance does the ordinary man or woman on the streets have in getting it right? But that is not true. Personal finance does not need to be overwhelming. For most of us, we need not delve into the complicated financial jargon that you see out there. Actually, all you need to do is keep it simple. By keeping it simple, you can really own your financial future. So the first thing you need to do is make a start. That's obvious. Of course, it will be much easier if you are starting to take control earlier in your 20s or your 30s than if you were in your 40s or your 50s. But I am a firm believer that no matter what you do from today onwards, you can make a significant difference to your financial future. The second thing you need to do is get educated. Start reading a good newspaper, for example, The Times. Read a few good books on personal finance. Go on a course. Start talking to people you know are good with their money. Now, I'm so impressed with one of our family members. She used to leave all the finances up to her husband. But as they began to approach retirement, she then decided she was going to take the bull by the horns and start getting to grips with their financial affairs. So many of us leave our finances or the financial management up to our partners. But actually, the death of a loved one is traumatic enough without having to come to grips with our personal finances and our situation as well. So get educated. You need to understand what the base rate is, how inflation works, what compound interest is, how it can work for you if you are in the money, but how it works against you if you are in debt. The other thing you need to do is understand the real state of your financial position. Open those unopened bills, understand what's going on in your bank accounts, what interest rate are you earning on your savings, what are you being charged on your credit cards. The next thing you need to do is set financial goals. Now, if you don't have any goals in life, you will never move forward. Goals keep us focused. They help us understand where we want to get to and what we should be focusing our time and our energy on. Goals should be smart, specific, measurable, achievable, relevant to our situation, and have a time frame to it. A really good example would be to save £10,000 within the next 2 years towards a deposit for a new home. The other thing you need to do is seek professional advice where relevant. Now, I'm a firm believer that many financial decisions can be taken by yourself. All you need is a little bit of knowledge and know-how. But there are times when it is wise to go and seek an independent financial advisor. For example, when you want to buy an annuity, or when you're surrendering an endowment policy, or you're trying to do a pension transfer. I would always go armed with basic knowledge though, so that you can ask the right questions and understand what you are being told. I would see a mortgage broker, a whole of market mortgage broker, if I was going to get a mortgage. And I'd see a tax advisor for complex tax positions in retirement planning. So let's look at some key financial terms. For example, compound interest. What is compound interest? Compound interest is interest that is calculated not only on the initial capital sum, but also on the accumulated interest of prior periods. Compound interest has been known to be one of the greatest mathematical discoveries of all time. That's what Albert Einstein said in any event. Compound interest really works for you if you're in the money. But if you are in debt, it can really work against you. Think of compound interest like a snowball. It starts off at the top of the hill relatively small, but as it goes down the hill, it becomes faster and it grows bigger and bigger over time. That is exactly what compound interest does. It gets bigger and bigger as time and rate increase. The second financial term that I'd like to discuss with you is APR, or the annual percentage rate. It is the cost of borrowing for 1 year on mortgages, personal loans and credit cards. It also includes any fees charged by the lender. Now, every lender has to calculate APR in the same way, so it becomes easier for you to compare when you're taking a credit card, for example. Now, an APR of 19% would work out to about £19 on £100 of borrowing in the first year. The next term I want to talk about is EAR, or the equivalent annual rate. This is the effective cost of borrowing on overdrafts for the first year. Now, it differs from APR in that it doesn't include any fees for being overdrawn. Now, all these things do need to be disclosed to you, but you need to be aware of the fine print. The next thing I want to talk about is the annual equivalent rate. This is the effective savings rate that you will earn on any savings account for the first year. It may include an introductory bonus percentage, but this does need to be disclosed to you. And don't be fooled, just because you got the best deal this year on your savings account doesn't mean you've got the best deal next year. You do need to remember that introductory bonus percentages fall away. So it pays to be proactive when it comes to owning your financial future. Every year you should be reviewing what are the interest rates you are earning on your savings account and whether or not you still have the best rate on offer. Now, we've come to the end of our first video in this 3-part series. I hope you found it useful. In the next video, we're going to be looking at principles 2 and 3. See you soon.